Hello everyone and welcome back to the channel. So last week I did make a video about why 95% of Pokemon investors will fail this cycle. So today I thought I'd make a video and touch on what the top 5% actually do to be successful. So yeah, do follow along, stay until the end because this is very important information. I just want to say that I don't do these videos to tell you what to do. I'm not saying that these things are going to happen 100%. I'm just simply sharing my own experience. As someone that's built a seven-figure business in the industry and has invested, multiple seven figures in Pokemon cards and other trading card games over the past 10 years. So I'm just sharing my experiences, my ups, my downs. I'm happy to share it all. And I just give you guys the tools and the knowledge to be able to do this for yourself and make your own informed decisions. So now that's out the way, let's get into the video. So this is a chart I shared in the last video, and I've shared it a few times on other videos that I've previously done. So I will go over everything and explain a little bit more about what information I'm sharing here. So the first thing I touch on, what the top 5% of investors do, we're going to be touching on market cycles and economic awareness. So the first point I make here is cycles are our compass, and I'll explain what I mean by that. So I do follow broader economic cycles, and here you can see how I've outlaid Pokemon on this cycle that we're in right now, which approximately goes for about 18.6 years. So we won't concentrate on this part here, but basically this is the start of the recovery after the last cycle. So you do have a recovery phase all through here. This phase of the cycle is less speculation. So I'm not saying that prices do not go up, but it's more of a normal environment. So you're not going to get the craziness that we're seeing right here or the craziness we're seeing right here. And I'm going to get into that in a second. But you do have normal price appreciation. So better sets tend to do better than worse sets, and it's more of a normal climate. So we did have this thing here where Pokemon Go came out, Evolutions come out, nostalgia got everyone back, and then we had overprinting of, especially XY Evolutions and Roaring Skies back then for anyone that was around. And there was just a huge negative sentiment. These sets were, the worst sets in the world because there was so much out there and no one was buying it. The prices plummeted, and then we kind of had a bit of a reset. And why I've got this here is the Fed funding rate. So you can see there's a lot of correlation, when contraction and expansion happens for interest rates. So you got cycles there in itself. And these grey areas are recessions, as I mentioned last week. If you haven't watched that video already, go back and check that one out. But when rates go up is a time of contraction. Interest rates or borrowing money, debt is more expensive, so you kind of see a pullback on luxury items or stuff like collectibles. Less people are buying them because they're worried about ever increasing cost of living. And then you have these phases here, which are the recessions. Again, many reasons why these happen, but the Fed has to lower rates in order to stimulate the economy, so people have extra money to put into the economy to buy things again. And then you have little phases of people spending money on luxury items again. But then sometimes you have, in the more severe economic downturns, which are the ones at the end of the cycle. So you got your mid-cycle slowdown, then you got your worst ones. So the mid-cycles are usually quicker, shorter, sharper, and you get a quicker recovery. And these ones are more drawn out. So you kind of get the blow off top, which is what we've got here, the most speculative part of the cycle. And then you get this recovery phase, and yeah, this is takes a long time. Interest rates are very low to stimulate the economy. But then you get a phase again, leading up to that when the recovery comes, which is here, which is about here on this chart. And then you have the C19 dump. So you got the dump that represents here in the chart here. You see interest rates come down, and then you get, this part here because money is being given out by the government and interest rates are low. People are starting to spend money and speculate on things again. So that's kind of the thought process behind it in a nutshell. So then we got the second one here. So look at external cycles before internal cycles. So what I mean by that is I'm looking at the broader economic conditions that impact things like collectibles. So like collectibles have their own, and we're talking about Pokemon cards here, so we use that as an example. So Pokemon has printing cycles, roughly, again, it's not exact because things go in and out of rotation due to it being a playable game, but it's usually around 2 years where Pokemon stop printing sets and they come out of rotation and new cards come in. So that's their own little cycle there. So we have to be aware of that. But I take that into consideration after where we're at in the broader cycle and the rate cut cycle. And there are other tools I use, but I'm going to keep it very simple today. So yeah, we get this COVID situation here. We get this represented on the chart. So we got a marked recession. We got low interest rates. That's represented here. And then we got this phase where people are spending a lot of money. So you got this phase where speculation happens. So that's what we're seeing there. Then we get the sell-off and money stops. We got rates coming back up. Sorry, this part here. So the conditions are tighter now. So money is tighter. They're sucking liquidity out of the financial system. And you get this phase here where people sell off. It becomes boring, but this is the biggest opportunity in stuff like trading cards. So this is where I bought a lot of my investments in trading cards. It's when a lot of people didn't act because it felt really bad. But again, this is how you can put everything together. And as I said, this allows you to figure out where you are in the cycle. And then we know that this part is coming next. So again, if anyone was part of my Facebook group the last couple of years, they would have known exactly what I'm talking about and how loud I was screaming about what I was doing and what I thought was coming. And then here we are, we see probably the biggest bull market we've seen, especially in modern Pokemon cards, in our lifetime. So again, we don't know how extreme it's going to be, but when you're in the middle of it, it's going to happen. So you can only sort of plan for the event to happen. We just don't know how big or small the impact's going to be. That's the only variable. We still know that it's very likely to happen. So again, you get the interest rates coming up, you get a pause, gives you a bit of confidence back, and they start dropping again. So this is going to stimulate. As soon as people know, again, it's news, doesn't have to happen yet. It just has to be spoken about where people have confidence back in the markets to start spending money. And this is more retail buyers, but I was buying all the way up here because that's where the opportunity is, whereas most people were scared and worried about cost of living. So this is the difference between the top 5% and the rest, basically. So just lastly, now Pokemon follows liquidity cycles, the same as crypto and stocks. That's why there's such a correlation between the two. They're all classified as risk on assets. So these are the types of things that impact risk on assets and make them go up and down, basically. So that is that in a nutshell. Let's move on to the next one. So the next one that I want to cover is the psychology and mindset difference. So this is the difference between how a successful investor thinks and how the rest think. So the 95%, so the average person that doesn't look at data and just gets sort of sucked into the hype. So they're emotionally reactive and hype driven. So they're buying at the worst times. And this chart I got down here. So we've got smart money and dumb money. That's what we call it in the finance terms. So as I was saying before, this is a massive accumulation phase for smart money. So you had so much time to buy, plenty of time at rock bottom prices. This is where your risk is the lowest. And then you got dumb money buying every time prices go up because there's hype, there's emotion running wild, and that's when the 95% tend to buy. So they seek validation as well. So again, I'll touch on this again. Sorry, we'll just go over here. So patient and data driven is the top 5%. That means we look at numbers, data, and what I explained before. So it's less emotion and it's more numbers and data driven. So again, nothing is perfect. We don't know what's going to happen 100%, but we can make more informed decisions and play the odds in our favor. And that's exactly what I do. So again, the 95%, they seek validation. So rather than look at data, they see what else is going on. Everyone's buying or focused on, the one card or sealed box. Let's use that as an example. So people don't want to feel left out. It becomes more of a status symbol or something to talk about with your friends, rather than the top 5% just is worried about profit. So this is, again, from an investing lens. So we're going to talk about investing here, so don't get that mixed up. So as a sophisticated investor, we want to buy things that are smart, so which is low risk, and things that have, a high upside potential. So that's what we're targeting. So we care less about what's going on and what's hyped, and we look for opportunities that people aren't talking about yet, but have potential to make gains with low risk. So that's the difference there. Next one, we got focus on short time frame. So The 95% are more micro, so they're very in the moment. They don't really look months, years ahead. They're really looking at days and weeks, so they're caught in that little bubble of emotion and FOMO. Whereas the 5% focus on long time frames. So as I said before, you got this huge thing here where like boxes are cheap, they're on clearance. It feels really bad to buy, but that is the opportunity. So you actually got way more time to buy. Stuff like Paldea as the example here. At dirt cheap prices, because one, we know where we are, we got our compass, and two, we see the data and we know where the opportunity is. There isn't a set in Pokemon's history that hasn't gone up past retail, given enough time in the market. So like that's a lot of data in your favor. So you got to use that to your advantage and just understand how these markets work. So lastly, we got so the 95% view their cards as possessions, while the top 5% view their cards as positions. The difference is someone that has, looks at something as a possession is more of a collector mindset. Is something they're attached to, emotionally, whether it's the value of it. There's a tie there that makes it very hard to make rational decisions because you are, so connected to that item you're buying. Whereas, as I said before, the top 5% just looks at it as a position. So the intention when buying that was to make money. So again, I'm going to get into plans a bit later or very soon. So there's a sound plan to get into position, and there's also a sound plan to get out of position, hopefully at a profit. So it's all very planned and calculated versus, buying or selling on emotion. So that's the huge difference between the two there. So moving on now, this is how the top 5% plan. So bear with me here. This is, very important to take note and understand what I'm telling you here. So what the top 5% do is they pick a niche to focus on. So I focus on a sealed product, and the reason being is for me to focus on just sealed items, it's a lot less of a pool to worry about than if I did sealed products, single cards, graded cards. There's so much more I have to cover, which takes way more of my time. So I'm going to be overloaded and I'm going to miss very, very good opportunities because my attention is too spread out. And this goes the same for like doing too many trading card games. So it's good to focus on one or two. But again, do what you enjoy, focus on what you love, and your results are going to be much, much better because you're actually interested. So the work doesn't feel like work. You actually have a bit of fun doing it. The next one we go, follow actual data and not opinions. So I've got here, this is TCG Player. Everyone's got access to it. I've got Surging Sparks as an example. So, two very easy to follow metrics is, so listings is supply. So we see that here. How much is actually listed? That's what's available to the market to buy currently. So that's supply. And then we got volume is demand. So how much are people buying at any one time? So we got here on the side the volume counter, and we see the bars at the back represent how many boxes are being sold at that particular time. So again, this is the demand at the time. And when you got supply going down, but demand still staying strong, well, that is just a recipe for higher prices. I'm going to go through phases of the markets very shortly. So the next one we've got is identify buying. So accumulation and selling distribution opportunities. And that's what I've got here. So again, this is also Surging Sparks. And this is a real life example that we can use, okay? So yeah, this is just about understanding liquidity as well. Before I get into this chart, I'm just going to explain that one there. So liquidity could be targeting popular characters. Why this is important is if you do focus on Charizards, Pikachus, Gengars, are very popular Pokemon, well, there's going to be more buyers for these things later on. Whereas if you go very niche into like Pokemon that aren't too popular, yes, there might be collectors out there, but you're just working with a much smaller pool, so that might be a lot harder to sell later. And again, there's ways to look at, there's different ways to look at liquidity other than what I just explained, but let's keep it very simple to just give you an idea of what to look for and what liquidity is in this particular market of Pokemon. So again, we're going to get to this plan now. So I've drawn out this chart. This is from Collector, I believe. This is a real life example of how someone, a sophisticated investor, would tackle this. So we got surging sparks. So we got pre-order price. Let's just say we bought 6 booster boxes during accumulation. So a good accumulation phase for Pokemon is to pre-order, especially when the market's quiet. So let's just say we paid $150 for our 6 boxes. So this is that green area there. We've got our 6 boxes. And then we sell 2 boxes during each distribution phase, and that's the red I've got marked here. So our first sell and our second sell. And the reason why, again, this all comes down to liquidity. So, and what I said about dumb money. So they're buying on, the way up. So emotions, FOMO is happening right here. This is when Pokemon is most liquid. So this is the easiest time to sell. This becomes much harder to sell. I'm not saying that you can't sell, but it just becomes harder just because people aren't focused on this particular set anymore. And the FOMO and the emotions out of it, and they've moved on to whatever the next shiny object or focus is on, in the market or social media, whatever you follow. So again, we got our 6 boxes. Our first sell is identified on this chart because we start moving up in price. So these 2 boxes that we sell, of our 6 boxes, we sell at $225 each. So that's done. So we've taken money off the table. We're lowering our risk. And then we get this phase of late accumulation. And why I've got late accumulation is if you missed out on surging sparks here, well, we can identify the chart that we've peaked. We've hit another low, and this is a good time to start buying again in anticipation for the next leg up. And we can anticipate another leg up because we know where we are using our compass or using our broader economic cycle. So this is where everything starts to work together now. Very important. So then this is our last chance to buy more or get into the market if we haven't already. But if we just got out and stuck to our plan, and with our 6 boxes sold 2, we've got 4 left. We just wait until see the top dotted line. We wait until we break out of that. So this is the last high here. We've got our low range. So this is our range now. And then the next time to act, this is how we know, is when we break this price point here. So once we're broken, okay, all right, we're going the next leg up. We're going to get ready to sell our 2 boxes again. And this time we're selling at $337.50. So again, 50% increase and another 50% increase, which compounds on the last price. So this will give us a total cost all up of $900. Total sales by the end of selling the 4 boxes of $1,125. So we profited $225 and still have 2 boxes to free carry. So that, in my opinion, is the perfect scenario for an investor. We're not trying to time tops. We're just trying to manage our risk or eliminate it completely, which we've done here. We've still made money and we've still got 2 boxes to do whatever we like with it. It doesn't cost us anything. So that's how you can sort of plan to put yourself in the best possible position. So just going over that again, this is a very powerful combination when all used together. So if we're doing one of these things, we might get results. If we do 2 of them, we're going to get better. If we do all 3 together, well, that's just a winning combination. So we've got here knowing we are in the cycle. So being aware of when the economy will expand or contract is the key to successful planning and timing. So what we went over before. So couple that with mindset. So collector mindset will result in collector behavior, FOMO, and holding too long. And then if you come in with an investor mindset, this will result in investing behavior, so planning and execution, which is the main thing to talk about here. And then we got the last bit of the puzzle, creating and executing your plan. And important to highlight your plan because everyone's in a different circumstance, as I point out here. So creating a plan that suits you and your goals will always result in success if you stick to it. So staying disciplined and repeating this process is what will take you to the top 5% of investors. So yeah, hopefully that makes sense. I don't want to go on too long with this video, but this is exactly the type of stuff I teach people inside my Discord community. So if that is something that interests you, I will leave the details below. You will get access to 2 of my courses that I created on investing and building a business in the industry. And it is the exact same framework that I use to be successful in this industry, whether investing or building a business. So I got you covered on both of those there. And you can go to the landing page and it'll show you exactly what else we do. So there's plenty of value there. I hope to see you there. Check us out. Thanks again for watching the video. I hope you learned something. And I'll see you next week where I will pinpoint exactly how I use market cycles to get the best possible timing in this particular market. So again, thanks for watching and I'll see you all next week.